Good evening, TheoTrade. This is Coy Rosenblum, and you're watching the Theo Nightly video for April 2nd, 2019, as we start quarter two of the new year. And we'll just do a quick quarter two update. We'll start with the S&P 500, which is making new 2019 highs on little momentum divergences, but through this open air spot in a continued uptrend. We do see our probability of expiring curve. And I'll take you through some of the indicators on the chart. And as we look at crude oil, bonds, leading stocks, and of course the volatility index, but that's what we'll do in all of these charts in a quick flyby update. This is derived from the implied volatility. Just take a look at any product, and in the underlying, you can see how the implied volatility goes out into the future. This being the SPX, it has plenty of weekly and multiple expirations per week, but a stock would not have that many. But nonetheless, it takes the percentage and price level, that's what we're looking at for the probability of expiring cone, and puts it into the future. So that's what we're looking for this indicator. It just gives us a sense of volatility and where the market might be into the next few months. Could be up above 3,100 toward 2,700, but still that is getting a little bit further than the purpose of this video. Mainly we're looking at two things on this chart. These indicators are volatility indicators, which is our average true range. Markets go through periods of low volatility and high volatility and cycle right back to low volatility. The ATR, or average true range, helps us with stop loss management, how to set targets, and really how to play aggressively or conservatively. In lower volatility environments, that means the future probably will be volatile, or at least will pick up in volatility, giving us an advantage maybe to breakout strategies or strategies that take advantage of higher volatility environments. That will be typically buying premium within out spreads, calls, puts, or any way to get long stock, long calls, long puts, and of course we like to do that with hedges. And of course, our favorite, implied volatility, which also takes place on this similar low to high, and then high to low. And finally, we look at the implied volatility percentile rank of all the markets or stocks we'll take a look at today. So those are just what we're looking at. If it seems a little bit overwhelming, there's a reason for each of these, mainly from volatility and what we expect the market to do within normal parameters. Anything with stop losses, targets, wide, tight, or conservative, or any positions with buying premium, typically down here, or selling premium, which is typically done in higher volatility environments. All right, let's pick it up. So this market is continuing to the upside. 2,900 is a logical upside target, and if we get above that, probably we'll get a pullback soon, but nonetheless, the market does extend toward 2,950, maybe even above that. The shift in tone has been based on China. We're having the China trade wars. That's taking a little bit of a more bullish tone. And of course, our big shift this year has been the Federal Reserve, which has stated that they will not raise rates at all, at least in the foreseeable future, for 2019. And that is seen as, the word we use is dovish, but that just means supportive of the economy. And if we're supporting up the economy, that supports or boosts up equity prices. So a Fed that is dovish or accommodating, not raising rates, that tends to support the economy and support the stock market. So we do have evidence or reasons to expect additional upside action despite how far it's come in 2019 already. On the flip side of the S&P, we look at the volatility index. That's our VIX. And of course, it is not quite making new 2018 lows. That's something to keep in mind. We don't necessarily look at this component of the VIX, but right here, price levels and any type of other range metrics. We started off this year near, really into December, 36 on the VIX. That was a large spike, and we are down to just under 14. The key inflection point is, of course, roughly 13 on the daily VIX level. And I've drawn a trend line here from earlier in 2018. So the thought process is if we get down to these levels, which we are, we can stay here a little bit longer than expected, probably a little bit longer than most of us would like to stay here. But nonetheless, it does pay to get long volatility or long different ways to play the market off of this spot from these levels, because the VIX tends to creep to the downside and then all of a sudden spike to the upside and fall right back. Kind of creep, 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 and then spike. There's a little bit of an advantage to playing long duration bullishly or with calls or call spreads in the VIX, especially as it drifts down toward levels that we are currently. Short-term plays only. In the bond market, that's our other focus, given that the Fed will, as stated, not raise interest rates in 2019. That's lit a fire under the bond market. So that puts downward pressure on bond rates. And as bond rates have pressure to the downside, bond prices get boosted to the upside. That is also a factor of probably the reason the Fed has chosen not to raise rates, which is that general indicators on the economy, bigger picture fundamentals, are deteriorating. So the Fed probably sees some bad things ahead for the economy, and they have chosen to make it public that they will be supporting the economy with low interest rates. That gives a double boost to the bond market, because investors, if they see the future bearishly or not quite bullishly for the economy and fundamentals and earnings and the like, well, they'll take their money out of the stock market and put it into the bond market. That occurred especially in the latter part of 2018. And we're seeing it happen now with that dual fuel on the fire, where the Fed says, we're here to help the economy, but also keep rates low. And that is pushing rates down and bond prices to the upside. We still expect that to continue a little bit higher. And if you are trading bonds at all, maybe through the TLT or IEF, we can take a look at those. See, we are in a pullback spot to our key moving average. And in terms of the ETF, roughly this 123.50 per share pivot. And that's again in the bond prices, IEF. Maybe another way to play it, which is your shorter term or 10-year, 7 to 10-year Treasury note. And that again is giving a buy signal for the moment into about 105.50 per share. Another market that typically tracks with the equity market and does well in an economic expansion is crude oil. Crude oil had a deeper pullback into 2019. Maybe didn't quite get as bullishly of a rally. Right? Equity markets are up here in terms of levels, but the crude oil is not. So it's only retraced about 50% of this pullback. And that's not even a pullback, that's a full-on reversal. And so we're about, again, halfway through that spot, low to high. And that's going to take us just above the 60 per barrel level. And again, not expecting a whole lot in terms of creep to the upside. We can again see the future in terms of volatility as it exists now. And that average true range has dipped down to about the 1.2, 1.25 level, falling about 50% from the $2 per barrel spot at the latter part of 2018. We can also look at gold. I think crude is a little bit better market to trade, but gold had its downswing into the latter part of 2018. And when the equity market was falling, bond market was rising, so was gold. Gold rose to the upside as a risk-off market or a defensive market. And that continued all the way to when the equity market was rallying, gold caught a bid and rallied with equity prices. That's why we can't necessarily see gold purely as a risk-on market or a risk-off market. And it's had a strong sell swing to the $12.90 per ounce level, a big bounce off of it, and now we're pushing back toward 1300, which should be seen as a key pivot for the precious metal. And we can, of course, finish up just with quick referencing of our popular stocks. Facebook has traded low to high. In a prior video, we talked about this 160 per share support level, reversal candle, and the likelihood that Facebook shares would bounce or retest the high. We call that a low to high trade. And as of today, that trade is complete. So take any profits that you have on the table in terms of this low to high play within a range in Facebook shares. Apple similarly is back into this just shy of the 200 per share level, which is a weekly and daily point pivot. We did get a 3-day pullback and a continued uptrend toward these spots. Google similarly did a retracement down as expected, and we're getting that little push to the upside as well as these uptrends continue. And we'll finish up with the Nasdaq just to look at where it is with respect to the prior high earlier in 2018 and where we are at this point. The Nasdaq is, of course, our tech-heavy sector, which, like the S&P, is just a little bit shy of this 7,700 level, which was 2018's high. So we are pushing into that spot as an uptrend continues. These gaps suggest urgency, and that suggests additional confirmation. But that's what we'll be watching in this week and as we start this new quarter for additional risk on or bullish equity market behavior that could take the Nasdaq through 7,600 toward prior highs or even above that. And in terms of the S&P future with our gravity spots and levels toward 2,900 or 2,950. And of course, that will play out through the bond market, through crude oil, gold, and leading sectors, and of course, leading stocks. This again is a broader perspective look as we start the quarter. Most videos tend to focus on a few stocks or a few levels, but this gives you a broader perspective that you can take and run with in your own trades or your own analysis. As always, be safe and be careful. This is Corey Rosenblum with your Theo Nightly video for April 2nd, 2019.